PACS Group, Inc., NYSE, PACS. Equity Research Report Date, September 10, 2025. Executive Summary. PACS Group, Inc. is a post-acute healthcare provider operating over 200 skilled nursing and senior care facilities. The company IPO'd in April 2024, pricing at $21 per share and debuting above that, valuing the company at around $4 billion. Verdict: cautious hold watch. PACS trades at steep multiples with meaningful debt. Investor optimism reflected in forward estimates may be overextended. Upside exists if integration works and earnings meet forecasts. But risks include deferred filings, leverage, and execution missteps. 12-month target range, $12–$16. Based on a blended model EV, EBITDA, peer comps, and conservative DCF current price. $8.07. Catalysts: continued strong earnings performance, timely SEC filings. To curb investor anxiety, successful integrations from recent facility acquisitions, analyst upgrades, and positive coverage risks. Heavy debt. Approximately $2.70 B total, with only 4.5 interest coverage. Filing delays or regulatory scrutiny. Execution, risk on cost synergies and patient volumes, potential litigation, including class action lawsuits. 1. Company overview and business model. PACS provides post-acute care, primarily skilled nursing services, through a network of about 200 facilities across 9 states, serving around 20,000 patients daily. Its business model relies on facility ownership and operation, delivering care to residents and billing payers, Medicaid, private insurance. Revenue is driven by census rates, reimbursement mix, and operational efficiency. 2. Valuation and financial metrics. Current valuation, TTM. P. Shreedambach and Trailin. FCF. 28.6 interest coverage. Historical valuation context. Current forward PE, approximately 7.0, is below the 5-year average, approximately 12.8. EBITDA, approximately 10.6, is below its 5-year average, approximately 14.7. PS, approximately 0.41, is also below the sector average, approximately 0.63. Here comparison: healthcare facilities typically trade at EV/EBITDA of 10 to 12. PACS 15 to 16 multiple looks elevated unless strong growth is delivered. The PEG ratio of 0.34 is attractive, provided earnings forecasts are accurate. DCF, intrinsic value illustrative, using a 7.5% WACC, 2% terminal growth, and moderate margin expansion, yields an implied equity value of approximately equals $14. Share. Base case range, $12, $16, 3. Profitability and efficiency: revenue, $3.56 be gross profit, $519 m. Operating income EBIT, $218.7 million net income, $92.3 million EPS, 68 cents ROAS, approximately 6.4% margins are modest, consistent with facility-based healthcare. 4. Liquidity and solvency: current ratio, 1.71 quick ratio, 1.57 debt to equity, 4.69 times, prox $2.7 billion debt versus $578 million equity. 4.5 debt is high, but serviceable. Refinancing risk exists if rates remain elevated. 5. Growth and earnings performance. IPO raised $450 million at $21 share in April 2024, valuing the firm at $1 for BQ22024 EPS. 38 cents share. Forward estimates imply earnings growth more than doubling in coming years. Analysts' consensus: strong buy with average target $1.33. Governance concerns: delayed filings, late 10QK submissions, and class action activity. 6. Dividend and capital allocation: dividends, none. Buybacks, negative shareholder yield, 4.3%, likely due to dilution. Cash flow is directed toward acquisitions and facility growth. 7. Management and governance. Filing delays and class action lawsuits raise red flags. Governance quality is uncertain due to limited visibility into board structure and executive track record. News, sentiment, and analyst coverage. IPO well received. Stock opened above offering price. Several analysts initiated with outperform ratings. Filing delays have damaged sentiment, though operational performance remains relatively solid. 9. Competitive landscape and work competitors. Skilled nursing operators such as Brookdale and HealthPeak, SWOT analysis, strengths, scale, post-IPO cash reserves, strong patient volumes. Weaknesses, high leverage governance concerns, no shareholder returns. Opportunities, aging demographics, expansion via acquisitions, Medicare reimbursement. Threats, regulation, litigation, staffing shortages, interest rate pressures. 10. Technical analysis, 52-week high, tilde, $43.9 52-week low, tilde, $8.28 RSI, approximately 21 deeply oversold. Trading pattern, volatile. With significant downside since IPO 11, industry and macro context. Post-acute care demand rising due to aging demographics. Key risks include Medicare, Medicaid, reimbursement changes, labor cost inflation, and high debt costs amid elevated interest rates. 12. Catalysts and risks. Catalysts. Strong earnings, beats. Resolution of filing issues, positive analyst coverage, successful acquisition integrations, risks, governance failures, litigation exposure, rising interest costs, execution missteps. 13. Comparative analysis with peers. Relative to peers, PACS looks cheaper on sales multiples, but richer on EBITDA multiples. Its forward peg suggests growth optimism, but execution must confirm the thesis. 14. Investment thesis and scenarios bull case. Margin improvement, debt paydown, smooth filings give $16 target. Base case, steady earnings, modest multiple expansion gives $12 target. Bear case, governance issues, litigation, earnings miss, gives $6 downside. Key triggers. Next earnings release November 6, 2025. On-time SEC filings, analyst revisions. Final word. PACS Group is a bold healthcare roll-up story with demographic tailwinds, but faces meaningful debt and governance risks. While the stock appears undervalued on forward metrics, investor confidence will hinge on consistent filings, cash flow delivery, and effective debt management. Recommendation. Cautious hold, watch until stronger proof of execution.